So, guys, welcome onwards into our second lesson for the beginner's guide. So, with they already completed the beginners, have I completed intermediates? Okay, so this is the intermediate video. This for the intermediate. Let's get straight into it. Please, if you are hearing any background noises, just try as much as possible to ignore that. I'm actually in the office, so people are talking around, and it might be captured by my microphone. So just ignore that and stay focused to my voice. And also, I noticed something from the other videos that whenever I'm using maybe a Word file or on my home screen, that you actually see that there are several mouse cursors on the screen. But when I'm doing the video, that's not the case. I actually found out when I was like watching the videos. I don't know the solution to that for now. I'm actually using Vimeo to record this video. So if anyone has a solution to that, you can let me know so I can fix that. Okay, so intermediate. So in the intermediate, you're going to look into other types, spread and slippage, pips, lot size or position sizing, then leverage. I don't know what's wrong with my voice. I think something is my throat. Something is my throat. Hope you guys can hear me clearly. So I'll be sharing both this and trading view for more illustrations. So let's get into it. Yeah, okay, intermediate. So the first thing here is note these two images. So I actually place these two images here for reference. So you can see these two images here. I labeled this one A. So A is for this line, B is for this line under. And then you can see C here, market execution, and D for these numbers here. So I labeled this for reference. So you can use this as reference when you are reading through. So you can, if you're reading through, you can see where I say there B A. So once you see all these things, just make reference to these pictures to give you further clarification of what I was trying to talk about. So moving forward, okay, let me just explain these images. So for these images here, it's already explained here. It just what this letter stand for. So this is equals this is the asking price, so or the offer, okay, and the and B equals the bidding price. C equals the market execution. Like okay, that's market execution. This is the other type, and this is the lot size. So this is an MT4 platform. Okay, I just did a screenshot from my phone for this. So what's this A and B? So this bid and offer. What this actually means is okay. Let's say you want to buy Bitcoin. This is BTC USD. So if you want to buy Bitcoin at market price, so this bid here is the current market price. As you can see, this candle here. As you forge ahead, you will learn about Japanese candlesticks, so you will get to know how these candles work. So as you can see, this candle, this is the current price on this candle. This is the opening price. This small thing here is the high. Then this is the current price where BTC is trading now. Okay, current price of BTC. So this is the bidding price. So if you as a trader you want to buy BTC now, the bidding price is the price that you actually want to buy BTC at. And then you have the offer price. This is the price that the brokers or the liquidity providers are willing to offer you. So it's like you want to buy what can I use now? You want to buy a wristwatch and you're bidding the wristwatch for maybe 5,500 naira. But the seller is willing to offer you like last it's willing to offer you 6,000. So that's what this is all about. So now the difference between this and this is called the spread. Okay, so what this means now is if you this market, if this is some market execution and you click buy on BTC, okay, as you can see now, if you click buy on BTC, this is where you think you are getting in, but this is where they feel you in. So your buy, the market is here, and you buy from here. The broker actually opens your position up here, not here. So before you be in profit, this thing has to reverse and move up to this point where they open your position before you can be in profits. If not, you will still be you'll be in loss. So once you open the position, you'll be in loss. That's the spread. So this here and this the difference between this and this is like the fee the broker charges you to open this position for you. So you start that position in loss. Okay. Hope you understand that. Then you have okay, sorry. This is other type. So this other type is actually now on market execution. So you learn more about that as you move forward. And this is the lot sizing. So you can change this 0.10. So this is a mini lot. Okay, a mini lot. So this is 0.10. You can change this to maybe 1 or 0.05 or 0.5, 0.6, 0.7. Okay, depending on the lot size you want to use based on your risk parameters. That's what I explained here. So let's move on. Other types. So in the foreign exchange market, there are few other types. Like other type mean the way you want to enter your position. Okay, if you want to take the price that the market is offering. So because from what I explained above, this is the bidding price, this is the price you want to buy, and this is the price that the broker or the market is offering you. Okay, so what other types means is this way you make your decision based on your other type is where you make a decision if you actually want to accept the price the market is offering or you want to get a better price. Okay, so moving on to other types, you get market order. So what market order actually means is, from what I explained above, is that once you click buy, they open a trade for you instantly. So it's an instant order execution. So whatever price the offers are bringing into the market, that's the price they will fill you in. So market execution is like the fastest possible type of execution. Once you click it, it executes you immediately. You're in the trade, but it doesn't guarantee it doesn't guarantee a reasonable price. So you can get filled at any price at all, depending on what the market is doing. So imagine if there is news and this will be talked about it will be explained as you move forward in this lesson. As you can see, that there are there's a topic there that says, I think the news or whatever. So you just come across it. So if there is news and the spreads increase, let's go back to this. This spread is like this size because the market conditions are good. Okay, this is a 5 minute chart. The market conditions are good. That's why this is like this. If there is a news or a high impact news that causes volatility, this offer price might be up here. It will never be here. It might be up here or maybe even up here because this is a 5 minute chart. It's a smaller time frame. So if news comes out, you want to scalp the news, like people that say they're trading NFP or they're trading FONC and they want to enter immediately news is out. And this spread widen. These brokers know that news is coming out. They always widen their spread during news release. And immediately there's news release, you see price of BTC as 27,021 and you enter a buy. If this red line is up here, your buy will open at this point. So you'll be in a loss of this whole price. You'll be in a very big loss. Not until price goes up to that point where they filled you in, you'll be in profit. Okay. Until price get there, you will not be in profit, you'll be in loss. So market order means instant execution. So once you click on market order, they execute you as any price that the market is offering. Okay, is actually not a good trading order type for me. I rarely use market orders now. I used it before, but I don't use it now. There are some pairs like in forex where market order is still good because they have a very low spread. So imagine spreads like Euro USD, GBP USD that have a spread of maybe just one. You won't even feel anything. Okay, you won't feel anything. It won't be like you are even slept or something like that. But for pairs like BTC, gold, that has a higher spread volume or higher spread rates, your trade might actually get messed up using this market order. So the next is limit order. So this limit order is an order to buy or sell a particular instrument at a specific price that you have decided. So if you want to use a limit order, you set your, let's say you want to buy BTC. You want to buy BTC and you see that the price is here, okay? And you want to set a limit. The limit order has to be below the current market price. So what this means is that once you set your limit order at this point, when price is here, once price get down to this point, it's going to fill you in. Okay, it's going to fill you in, and you don't get slipped by spread or something like that. But another downside to limit order is that, let's say this spread is this wide. These brokers, they know what they are doing. This is actually manipulated. Let's say this spread is this wide and you have a limit order here. If this market price gets your limit order, it will not trigger until this second one crosses your limit order. It will not trigger you there. You understand that? Not until this second one crosses over, it will trigger you on your limit order. Okay, that's it. So limit order means you want to buy or sell an instrument at a price that you are okay with, not the price that the market is offering. So another one is stop order. Okay, is in stop order you also have a stop loss, you have take profits. So what stop order means is, let's say you want to buy BTC. A stop order has to be above the current market price if you want to buy, or below the current market price if you want to sell. So if you want to buy BTC and you see that the price is here, what you can do is set a stop order at this price, maybe 27,043. And when BTC starts moving up, moving up, moving up, once it gets that price, it takes you in and you're in the trade. I don't actually use it. I haven't used this other type before. I just know about it. So, but where I actually make use of this is when I'm placing my stop loss or take profits. So it's still the same concept for a stop loss and take profits. So, okay, okay, yeah, you see take profit order. So take profit order means this is an order you set. Let's say you're selling BTC at 27,000 and you want to take profits at 26,000. What you do is set your take profits at 26,000. So once the market is moving and gets to 26,000, you don't need to be there to close the trade by yourself. Once it gets to 26,000, it automatically closes the trade for you. That's same for stop loss here that is placed with this stop order. If you have a stop loss and you are selling, you also have your stop loss above at a price that you think once BTC get there, it might reverse, and you don't want to lose more. You don't want to lose more because your stop loss will be calculated with your risk parameters, the amount you want to lose. So once it gets your stop loss, it takes you out. You don't need to be there present to close the trade and cut your losses short. Then you have trailing stop order. This is just you moving your stop as you're in profits. Let's say you sell BTC 27,000. I want to take a profit at 25,000. You see BTC is going from 27,000 to 26,500, 26,400. What to do? You can trail your stop. That's your stop loss that you placed above, so you don't lose more than you want to lose. You can bring that stop loss into profits. Okay, you can move that stop loss into profit. So in a case where maybe you're in the sell for BTs and you're in profits and in so a particular time or period, it just reverse. It starts to reverse in the opposite direction of your trade. It just takes you as in profit, so you secure a little bit of profit instead of losing everything. Or you can move your stop to break even. Break even means you put it at the points where you entered the trade. So once price get back to that point, if price reverses and get back to that point, you don't lose, you don't gain. You're just neutral. Okay, that's what trailing stop means. So I hope this is clear. So do read through this manual and also use this video as a guide. So with two of them, you'll be able to understand what I'm trying to emphasize on. So one thing else I want to point out is for this. Okay, I think okay that will come in spread. That will come in spread. So spread and slippage. Spread and slippage are two important concepts in the world of trading, including in foreign exchange markets. They are both related to execution of trades and can have an impact on traders' overall performance. Here are some examples of spread and split slippage. Here's an explanation of spread and slippage. So they say this can have an impact on your overall performance. So I remember a particular trade I was in. It was on gold. I was buying, and I didn't actually make my that time analysis wasn't as good as it is now. So I was actually selling, trying to buy goods when the trend was bearish, strongly bearish. So you know what that means? It's like you want to stand in front of a moving trend and stop it. You're going to get crushed. And that's what happened to me. So I was in a sale. I have my stop loss at 14 pips. So in case if the trade goes against me, I'll just lose 14 pips. And you know what happened? The markets moved really fast and I was slipped 40 pips. So instead of them taking me out as 14 pips, they took me out as 40 pips. And that's actually messed up my whole entire trading week. Like almost a month, I was having back-to-back losses. I was having PTSD. I couldn't take trades that even if I see my setup align, I couldn't take the trade because I was scared from what happened to me before. I didn't want that to happen again. I was not following my plans again just because of what the sleeper did. So you have to be careful when you are taking trades, like the particular periods you're taking trades. So know when price is possible, it has the possibility to sleep you. Slippage is a very bad thing. Believe me, I was sleep 40 pips. Some people get sleep 90, 100 pips during news release, especially FOMC. So spread, I've actually mentioned spread before. So spread in forex refers to the difference between the bid price and the ask price. So the purpose of spread represents the cost of entering a trade. So this is the charges the broker charges you to facilitate your position. So they are the ones connecting you to a liquidity provider. So you have to pay them something to execute trades for you. So here there are types of spreads: fixed spread, variable spread, impact on trading. So impact on trading. Okay, the two types of spread are fixed spread and variable spreads. These are okay. These are not that so important. I don't think there are brokers that offers fixed spreads currently because everyone wants to make money. So rarely you see a broker that is offering fixed spread. Spreads are always variable. They change with market conditions. So impact on trading. What's the impact of spread on trading? So narrow spread are generally preferred by traders because this results on lower trading costs. So as long as you have a narrow spread, the trading cost is lower. So with the example I gave you on BTC, that's a wide spread actually. So the fee they are going to charge you on BTC is going to be higher than what they will charge you on Euro USD. I think Euro USD and GBP USD has the lowest spread across all trading instruments. They have the lowest because they are more liquid. So why spreads increase is due to liquidity. So if a pair is less liquid, the spread will be too wide because there's no money. There's no money in the market. There are no much participants in the market. Okay. So and traders generally prefer smaller spread. That's why if you're choosing a broker, it's advisable to check their spread. Better you open a demo account and test it out and see how their spread are because a lot of broker will kill the spread, especially brokers like OctaFS. So when I see people using OctaFS and they are new to trading, they want to use OctaFS. I'm actually sorry for them because those brokers their spread is too bad. So you can see yourself in a position and you have your stop loss, you have your take profit, and you see price moving against you. Price is like halfway in your stop loss. It's not even up to your stop loss, and you check your trade and you find that they have closed it out. It's actually spread. So let me give you a brief explanation here. So if you have your stop, let's say you open a trade here. Okay, if you open a trade here now and you place your stop loss here, if this thing start to move up against you, you get stopped at once this particular line. You see this particular red line here. You get stop loss once this particular line hits, not the market price. Oh. So let's say you're checking on your trading view because trading view doesn't show this and this because trading view is just a charting platform. It's not related to any broker. So what it's going to show is the current price. Let's say you're checking on trading view. And on trading view, you're seeing yourself that you're still in the position. You might open your MT4 and you find out that the broker have already closed you out because of spread. This line have already hit on your broker, but on trading view, this is what you're looking at. Then in reverse, this is how brokers make money. They just know what they're doing. They just want to make money off you, and this is how they kill new traders. So in reverse, for take profits, let's say you are buying BTC and you have your take profits at 27,081, and this thing starts going up to 27,081. When this red line touches your TP, they don't close you out. Okay, they don't close you out on your TP. They will only close you out if only this one now. Okay, this one now gets your CP. If this one doesn't get your TP, they will not close it. So you get that? They will not close it. But maybe you will look at your trading view and see that okay, I think if you are buying, they open you here and then the spread will this I think this will go in reverse once it's getting to your take profit. This will go in reverse. So you see the market price getting to your TP, but the spread is still below your TP. And you're checking your trading view that you have hit TP, while in your NT4 they still haven't closed you in profit. Not until these two lines cross over your TP line that you'll be closed. But when it's come to hitting your stop loss, not until one line, which is the one above, crosses your stop loss, they will stop you out. Okay, have that in mind. So moving back to um, okay, we've talked about spread, types of spread, then slippage. So slippage definition. Slippage refers to the difference between the expected price of a trade and the actual price at which the trade is executed. So this is the slippage. The actual price of a trade and the price is executed. That's the slippage. So it occurs when the market condition changes between the time a trader places an order and the time it gets filled. So if you place a trade now, and maybe your internet is lagging, and the price changes, you're not going to get filled at the price you actually place the trade. You're going to get filled at a higher price. So traders should be aware of the times which slippage is high to avoid them as it can ruin your hard work in just a blink. You can just blink and see slippage ruin your hard work. So you need to stay away from high impact news and end of day trading. So when you are having high impact is like NFP, which comes every first Friday of the month, or FONC every third Wednesday or second Wednesday of the month. You need to stay away from trading. You need to stay away from trading, and especially opening a position like few minutes before NFP or FOMC. You are trying to ruin your day. You are trying to ruin your trading account if you do that, because once this new release comes, it comes. I think NFP is 2:30 1:30, okay, 1:30 in Nigerian time, and FOMC is 7 p.m. at night in Nigerian time. So immediately is if you open a trade, immediately is 7. The broker, that's when the broker starts widening they're widening their spread. That's what the slippage and that's where the slippage happen. So they might widen their slippage. Maybe you are in trading view, you are looking at it, it doesn't stop you out in trading view, but they will the slippage or the amount of spread the brokers are widening their this thing, other executions. This thing, the asking price goes above your stop loss and just closes you out. It won't respect your stop loss. Once you are slipped, it doesn't respect your stop loss. It doesn't know if your stop loss is there. It just jumps above your stop loss and you lose more than you are supposed to lose on a particular trade. So high impact news and end of day. So when we are getting to the end of the day, that's 10 o'clock at night Nigerian time. That's like the end of day of the trading market. You see that the spreads widen because there are no liquidity again. Every market have closed. No money into the market. So liquidity means money. There's no money in the market. Once there is no money, the spread is wide. Okay, the charges to execute that trade is wide because the market is not moving. So the brokers are going to find it difficult to, execute your trade. So they charge you more. So be careful of these times. Okay. So here you have causes of slippage. I've already explained. So read through this to get further insights. Okay. Then okay, you also have negative slippage and positive slippage. So when you have a positive slippage, that you actually redress, that's when it's good. So that means this is when price is moving in your direction and maybe suddenly there is news and the news comes out and jumps your TP or jumps above your TP. It doesn't close you as your TP, it closes you way down at your TP. So you tend to make a lot of money. But this is actually rare. It's very rare in the trading markets. Not a lot of people get to have this feeling. Okay. So moving on to pips. So pips is the smallest price increment that can be observed in the exchange rate for a currency pair. Okay. So pips is this is how we measure our stop loss, our TP, measure it in pips. So if you are checking how much money you are making, you say I'm up 100 pips, I'm up 200 pips, I'm up 500 pips. That's right. You cannot be up 500 pips. Okay. Um So the example given here is that if Euro USD currency pair moves from 1.100 to 1.1000 to 1.100001, that's a 1 pip increment. Okay, that's a 1 pip increment. So if you add that to if this turns to 1.001 to 1.010, 1.010, that's actually 10 pips. So you're up 10 pips or you're down 10 pips. So there's no need to start trying to calculate how how to do your pips. So in trading view have already made it in such a way that there is reward to we calculate your pips. So let me show you. Let me show you trading view. So I'm actually short on GBPSD. I'm in big profits now. I'm actually like so it's like 65 pips in profits. And I'm targeting this low 1.2. I believe this 1.2 will get taken out because we have been dropping for a very long time. And this 1.2 is a likely target, a likely draw on liquidity because it's a round number. So imagine if the price of cement wants to fall. The price of cement, see, if it's falling, from maybe 10,000, it's falling 10,800, 10,000 this, 10,000 that, and it wants to get to a certain price, a particular price to stop. It doesn't stop at maybe 7,825 naira, 23 naira. It actually stop as a round number, maybe 7,500, 7,000. So that's the logic I'm using here. Since this G is dropping, all the institutions and banks will be banking on this level 1.200. This is a very significant level. So that's why I'm holding this trade. So it's about 124 pips. So if you look at this risk reward tool here, and you look at this number on top where you see 20.0, that's actually 20 pips. So if you want to enter a trade, once you place this, you can check on top to see how many pips you are getting. And also remember it's different from every other pair. In BTC is different and in gold is different. But if you are trading a forex pair, they are all the same. If you are trading a commodity, they are all the same. If you are trading a crypto, they are all the same. So you need to understand how it actually works and how to calculate it. So you don't go to BTC and play something like this and be looking at it and think it's 20 pips you are placing while it's 200 pips. So if you look at BTC now, if I can place this on BTC here, you can see this has like 22508. So it's different. You just have to study and know what this 22508. I think this 22508 is 250 pips. Yes, that's 250 pips. So it's different. On gold is different. So that's the trade is running good. I believe I've explained what pips is. So these numbers here are the actual price. So one point 1.2808 to 1.2100 is actually 208 to 009 to be 10 pips. 009. So this should be from here now to here should be actually 20 pips. Okay, just need to do your personal study just to understand very well. Okay, I think I've covered that for pips. So when it comes to calculating pips and money, this now goes hand in hand with lot size. Did I treat lot sizing? We haven't got into that yet. Okay, we're still getting to lot size. So pips works hand in hand with lot sizing. It depends on the contract size. So for forex, okay, for also forex gold, a one standard lot size, one lot. If you use a one lot and you have a 10 pip stop loss, once gets to that 10 pips stop loss, you're going to lose $100. So one standard lot for 10 pips is $100. One standard loss for 20 pips is $200. So if you step that down to 0.10, that's a micro lot, 0.10 micro lot. Micro lot can be anywhere from 0.10 to 0.99. All those are micro loss. So in 0.10, if you're using a 0.10 loss and your stop loss is 10 pips, so if price takes yours on that 10 pips, what you're going to lose is what? $10. So let's step it down again. If you are using a 0.01 loss size and you have a 10 pips stop loss, if price takes you out, what you're going to lose is $1. So you can take this analogy now and then transcribe it to maybe you're making 50 pips, you're making 100 pips, and the lot size you're using based on your account size. Okay, that's that for pips. So moving on to lot size. So lot sizing in the context of trading, this actually depends on your account size and your risk management appetite and your risk appetite. So let's say you have a $10,000 account and you want to risk 1%. 1% of $10,000 is I think $100. So with what I've explained to you now, your the lot size you can use and the amount of pips you want to risk. If you're risking 10 pips and you have a $10,000 account, you know that you want to risk 1% and your stop loss is 10 pips. So what you're going to use is one lot. So if price stops here, you are going to risk $100. But remember what I said during when I'm explaining slippage. If price slips you're in a position and price maybe in a news release price slips you might be using $300 for your 10 pips and your one lot you might be using $300. So that's why it's not good to trade the news. But if all conditions are clear, if everywhere is okay, you just lose $100 plus spread commission. That's just a tiny fraction. So lot size, your lot size can be based on your account size. Some people use account size. So if you're using a lot size calculator, there are some bots that do lot size calculation. So your account size, you just calculate your account size to the barest minimum and set this thing a lot size for you. Or you can be using a fixed slot like I do. I use a fixed slot. So I just calculate my pips and then know how much I want to risk. And I use a fixed lot size for every trade, no matter my account size. I use a fixed lot size until I want to increase. If I want to increase, I can increase it. Okay. So that's a fixed lot. Then volatility based lot size. And I don't know what that actually is. I haven't used that. So I put that in there for your study, just for you to have it at the back of my mind, not that you might actually be using it. So these fixed loss and account-based loss size are the common ones in the forex market. And then you have percentage of accounts. Okay. So percentage of accounts, fixed lots, volatile based loss sizing, which I don't know what it is, and account based loss sizing. So yeah, the type of lot I just talked about, standard lot, mini lots, micro lots. Then leverage. So the leverage is the last thing we are going to talk about in this video. So leverage refers sorry. So leverage refers to borrowed capital. So as long as you're trading with a broker, you're trading with borrowed capital. Because that money you have in your account, even if you have $10,000 in your account and you want to open a one standard lot, which will risk you only $100, you don't have enough money to do that. So to open a one standard lot, you need at least in a neutral condition where there is no broker, you want to go straight to the liquidity provider. To open a one standard lot, you will need at least $100,000 in your balance. But you can see that today you see people that can open one standard lot on their account of maybe $20, $50. You can still open a one standard lot. That's due to leverage. So what leverage does is that you bring one person. If you want to open an account that is worth $100,000, what you're going to do, depending on the amount of leverage you're using, you bring 1% of the required capital to open that, and the broker brings 99%. Okay, so they will leverage your accounts in a way that it will match what I just explained now. To match it. So leverage can range anywhere from 1 to 100, 1 to 1,000, 1 to 5,000, 1 to 500, 1 to 200. So what this 1 to 1 to this, 1 to this, 1 to this, 1 to this mean is that you are using one 1% of this capital to control a position that is worth like 5,000 times. That is like 5,000 times your initial margin. Okay, your free margin. So you are controlling a position that is 5,000 times. That's 1 to 5,000. If it's 1 to 100, you're controlling a position that is 100 times more than your account size. If it's 1 to 200, you're controlling a position that is like up to 200 times more than your account size. So with that, you can see that people, if you, let's say you have a account balance of $1, you can go to your broker and set your leverage to 1 to 500, 1 to 1,000. You can be able to open a trade on maybe GBP USD, and you see they open the trade for you. Okay, but if you set it to 1 to 100, 1 to 50, they will not open the trade for you because your account size is too small. But once you keep upping your leverage, you can be able to trade smaller amount. That's why you see people that can say, okay, I turned $1 to $100. I turned $1 to $10. That's due to this leverage. Minus this leverage, a lot of people won't be able to trade in this market. Okay. So leverage ratio, what I just explained, 1 to 500, 1 to 1,000, 1 to 50. Okay. Then you have margin. So margin is the amount of money that a trader must deposit with their broker to be able to open and maintain a leverage position. So if you want to open a 0.01 lot on maybe GBP USD on your account and you have, let's say, $1, this is the leverage. Depending on your leverage, it can open. But if your leverage is lower, so you can see on your MT4, if you open your MT4, you can see your account balance, margin, free margin, equity. So that margin means the amount you have to open a particular position. Then if you check any pair, any currency pair on the MT4, if you check it and check the details, you can see the required margin to open that position, to open a trade on that pair. So you can use that to judge if your account balance is able to open this position. Then margin call. So if a trader's loss on a leverage position exceed the available margin in the account, the broker may issue a margin call. So what margin call means is that you can see, maybe if you check the internet, you can see people that are maybe trading the news, and the news is going against them. Maybe they have multiple positions. The news is going against them, and suddenly you can see that those positions start to close on their own. They start closing on their own. So what happens is that once you have positions opened and the price is going against you, and your this thing margin, the margin you have on those trade has is now drying out. Let's say you have a margin of that position you have is equal to maybe $500 of margin, and you can see that due to the loss, your free margin is going down. Your free margin is going down, and suddenly your free margin is now in the negative. Once your free margin is now in the negative, the broker starts closing out those trades just to fill your free margin. Okay, they just before you know it, they just close everything out. They close everything out. Even without the trade hitting your stop loss, they can close out all your trades. Once you are getting a margin, that's what's called a margin call. You have exceeded your margin for that particular position you are holding. Maybe there are people that do stack trade. Maybe they open positions there and later they stack another one. If the as price moves on, they stack another one. So if that price starts reversing and price reverses more than the and exceeds the margin that you're using to hold all those positions, you start closing you out. And before you know, all your positions are gone. So leverage and risk, we have already talked about that. Leverage, how you leverage your trades 1 to 500, and then how you manage your risk with that leverage. So regulations. So all brokers are regulated. No, no, not all brokers. Some brokers are not regulated, and the level of margin or the level of leverage a broker can issue to its customers depend on its regulatory authorities. So there are some authorities that might tell brokers, it depends on the country, that tell brokers you can't give your customer more than 1 to 500, some more than 1 to 200, some don't even do up to 1 to 100, 1 to 100. Okay, so it depends on the regulations and other authorities. So demo trading, all these brokers they offer demo trading. So this can allow you to virtually test out all these things, test out the leverage, test out the spread from your demo trading. So if you find out that you are okay with it, then you can go ahead. Some traders might be okay with high spreads because maybe they are swing traders. Okay, some will not be. If for scalpers, people that enter trade within the day, that open and close trade maybe within 5 minutes. They might not they cannot trade with brokers that doesn't offer tight spread. So you actually learn about types of traders as you move ahead. So that's just the end of our lesson. So recommendation, as this section draws to an end, ensure to download the MT4 or MT5 app anywhere you want. You can download MT4 or MT5. Depends. The MT4 was the older version, then MT5 the newer one. The MT5 is a bit more beautiful than MT4, but it's still the same purpose it serves. When you go to your broker, you choose which one you want. So sign up with any broker of your choice, which meets your requirements. So check their spread, the spread they offer, how much they do their this thing. Demo trade. Some brokers just offer you $100,000 on demo account. That's not real. So you have to go with brokers that may offer that give you a chance to get $200 on your demo account, $200, so you can take it and make your demo trading feel real. Okay, if you have a $200 account, you can deposit and you cannot deposit $100,000. So don't go and be looking for brokers that only offer $100,000 on demo accounts. Make it feel real. So apply these trends you have come across. So apply everything you have come across. Please trade and have a feel of how it works. Please trade and then you can see how price fluctuates up and down. You just please trade on all any asset type. Bitcoin, this, that one, that one. Just please screenshot and just watch and see how it goes. Then apply the chat work that will be discussed ahead to it. So we're going to talk about chat work as we move ahead, as we forge ahead. So we apply all these things and make time to practice. Okay, okay. Make time to practice. Make time to practice. And always refer to this video for clear understanding as you are reading this guide. And that's that for today. Hope you guys got the information I'm trying to pass out today. And then see you guys in the next one. Bye. Peace.